Hey everyone, welcome back to our channel where we bring you the latest news from around the world. In today's video, we have some breaking news from the financial sector that's making headlines. Silicon Valley Bank, a tech lender based in California, has collapsed after a stunning 48 hours that led to the second largest failure of a financial institution in U.S. history. Let's dive into the details. On Friday morning, California regulators closed down Silicon Valley Bank and put it under the control of the U.S. Federal Deposit Insurance Corporation, FDIC. As a receiver, the FDIC will now liquidate the bank's assets to pay back its customers, including depositors and creditors. The FDIC is an independent government agency that insures bank deposits and oversees financial institutions. It has assured that all insured depositors will have full access to their insured deposits by no later than Monday morning. Additionally, it said it would pay uninsured depositors an advance dividend within the next week. Silicon Valley Bank, previously owned by SVB Financial Group, didn't respond to CNN's request for comment. The collapse of Silicon Valley Bank has shocked the financial sector and is likely to have ripple effects on the tech industry and startup ecosystem. What happened? All started on Wednesday when SVB announced that it had sold a bunch of securities at a loss and would sell $2.25 billion in new shares to shore up its balance sheet. This news triggered panic among key venture capital firms, who reportedly advised companies to withdraw their money from the bank. As a result, the company's stock plummeted on Thursday, taking other banks down with it. By Friday morning, SVB's shares were halted, and it had abandoned its efforts to quickly raise capital or find a buyer. This led to several other bank stocks being temporarily halted on Friday, including First Republic, PacWest Bancorp, and Signature Bank. The collapse of Silicon Valley Bank has shocked the financial sector and has raised concerns about the stability of other tech lenders. It is likely to have ripple effects on the tech industry and startup ecosystem, as well as on venture capital firms that have invested in these companies. The Federal Deposit Insurance Corporation, FDIC, took over Silicon Valley Bank in a mid-morning takeover, which is a departure from the agency's usual protocol of intervening after the market closes. The timing of the takeover is noteworthy as SVB's condition had deteriorated so quickly that it could not wait for the market to close. According to Better Markets CEO Dennis M. Kelleher, the bank's depositors were withdrawing their money so quickly that the bank became insolvent, leading to an intraday closure that was unavoidable due to a classic bank run. Silicon Valley Bank's decline can be traced back to the Federal Reserve's aggressive interest rate hikes over the past year. Banks had loaded up on long-dated, seemingly low-risk treasuries when interest rates were near zero. However, as the Fed raises interest rates to fight inflation, the value of those assets has fallen, leaving banks sitting on unrealized losses. Tech companies have been hit particularly hard by higher interest rates, undercutting the value of their stocks and making it difficult to raise funds. This prompted many tech firms to draw down the deposits they held at SVB to fund their operations. According to Moody's chief economist Mark Zandi, higher interest rates have also lowered the value of SVB's treasury and other securities, which the bank needed to pay depositors. All of these factors contributed to the run on their deposits that forced the FDIC to take over Silicon Valley Bank. Deputy Treasury Secretary Wally Adeyemo reassures the public about the health of the banking system after the sudden collapse of Silicon Valley Bank. In an exclusive interview with CNN on Friday, Adeyemo said that federal regulators are paying close attention to the situation and are confident in the resilience of the broader financial system. Adeyemo's comments came after Treasury Secretary Janet Yellen convened an unscheduled meeting of financial regulators to discuss the implosion of Silicon Valley Bank, a major lender to the hurting tech sector. According to Adeyemo, the Dodd-Frank financial reform overhaul signed into law in 2010 has given regulators the necessary tools to address incidents like the collapse of Silicon Valley Bank and has improved the capitalization of banks. He added that U.S. officials are currently gathering more information about the situation. While Adeyemo declined to predict any impact on the broader economy or the tech industry, his reassurance about the health of the banking system and the tools available to regulators may help calm concerns about the impact of Silicon Valley Bank's collapse. Due to excessive cash withdrawals by its customers, Signature Bank in New York was also closed on Sunday. According to state authorities, they took control of the bank to stabilize the financial system. Depositors from both banks will receive their money, according to federal officials. President Joseph Biden addressed taxpayer concerns today from the White House due to the consequences of Silicon Valley Bank's bankruptcy. Americans can have confidence that the banking system is safe, Biden said at the White House. Your deposits will be there when you need them. Echoes of 2008. Despite initial panic on Wall Street over the run on Silicon Valley Bank, SVB, analysts believe that its collapse is unlikely to have a domino effect on the banking industry. However, smaller banks tied to cash-strapped industries may face difficulties. The system is as well capitalized and liquid as it has ever been, said Moody's chief economist, Mark Zandi. He added that the banks in trouble are too small to pose a significant threat to the broader system. However, Oanda's senior market analyst, Ed Moya, warned that smaller banks linked to struggling industries like tech and crypto could be in for a rough ride. Moya noted that Wall Street was aware that the Federal Reserve's rate-hiking campaign would eventually cause problems, and small banks are currently bearing the brunt of it. While the collapse of SVB has caused some concern, the banking system as a whole is believed to be in a strong position to weather any potential challenges. However, smaller banks may need to prepare for some turbulence as they navigate the current economic landscape. Idiosyncratic situation. According to the FDIC, the relatively unknown bank was one of the top 20 American commercial banks, with $209 billion in total assets last year. However, it has now become the largest lender to fail since the collapse of Washington Mutual in 2008. Many of its depositors, including nearly half of all venture-backed tech and healthcare companies in the U.S., withdrew their deposits as the bank's condition deteriorated. Despite concerns over the impact of SVB's collapse, analysts believe that the banking system is more resilient than ever before. While smaller banks tied to cash-strapped industries may face difficulties, larger banks are too well capitalized to be significantly impacted by the crisis. Wells Fargo senior bank analyst Mike Mayo called the situation at SVB an idiosyncratic situation and noted that the banking system is now more resilient than it was during the global financial crisis 15 years ago. As the financial industry continues to grapple with the fallout from Silicon Valley Bank's collapse, experts remain cautiously optimistic about the overall health of the banking system. Rate hikes take a bite. In the wake of Silicon Valley Bank's collapse, other banks have also been affected by the recent market turmoil. Crypto-focused lender Silvergate has announced it is winding down operations and liquidating the bank due to financial losses caused by the volatile digital asset market. Signature Bank, another lender, has also been hit hard by the sell-off, with shares dropping 30% before being halted for volatility on Friday. According to Conrad Alt, co-founder of Claros Group, SVB's institutional challenges reflect a larger systemic issue faced by the banking industry. He argued that banks are sitting on a significant amount of low-yielding assets, which have been negatively impacted by the rate increases of the past year. Alt estimated that these rate increases have resulted in the loss of approximately 28% of all the capital in the banking industry as of the end of 2022. With the financial losses experienced by these banks, it remains to be seen how the wider banking industry will respond to the challenges presented by the market turmoil. Thank you for watching our coverage on the sudden collapse of Silicon Valley Bank and its impact on the broader banking industry. While the situation may be unsettling for some, experts and regulators have emphasized that the banking system is well capitalized and equipped to handle incidents like this. However, smaller banks with ties to cash-strapped industries may face challenges. We will continue to monitor developments and provide updates as they become available. Thank you for tuning in.